will talk about market resilience, exploring US indices amidst PPI and CPI surprises. Hi guys, this is Shilpa Raidas and welcome to Midweek with Indiacharts and welcome you, Jay.
Hi, how are you doing?
I'm doing very good, Jay. How are you?
All good, all good.
Wonderful. Jay, we are excited to know your views this week at our midweek. So let's begin with the first question for you. So, Jay, what we have seen is higher than expected PPI and CPI data led to some nervousness for a brief while, but then it was short-lived and the US indices started doing well again. What's your take on this and what's your outlook on the US indices, Jay?
Yeah, so in the previous week, we got these data, especially PPI data. CPI, I think the release was prior to the last week. But yes, I mean, in both of the cases, the result, the number was above the expectation, and which meant that, we have been speaking for this for a while, that the 6 rate cuts which the market is anticipating, that might not come by, and if that doesn't come by, then basically that would not be great for the market. So when these data came out, there was some knee-jerk reaction that we saw on that particular day, but once again the US indices started inching higher. Now the thing is that rate cut, I mean, in March, that is not happening. Probably in June, May or June, that is the best case where, we can see rate cut. Now, one more risk, which I feel the market is not pricing in right now, is the Red Sea issue. And in fact, today also, there was some news that came that Israel is now attacking Syria. So, this geopolitical, risk, that is something that is there, and the market is sort of not recognizing it. So this is specifically I'm talking about the Red Sea issue, because last week or last to last week, when I was hearing many con calls of the companies, so they were telling that this Red Sea issue is for real, and due to that the shipping cost has gone up by say 30-40% or so, and that is leading to the increase in the price of the goods as well, which can be can get impacted in the price of the goods. So obviously it will have its own lag effect, because the goods will come, then it will be sold, so there will be those lag effects. But yes, I mean, this risk is definitely there. And honestly, when we look at the US indices, I mean, we don't really get that sort of comfort. So wait, let me quickly share my screen. So see, we have been talking about this, that this pullback in S&P 500. So while it has, scaled out the previous high, but it does appear like a corrective pullback. That is because you can see that the highs and lows are overlapping over here. Okay. If the highs and lows are overlapping, then it cannot be impulse, which means that either this is A, B, C, D, E, something like that, this is A, B, C, D, E, and this is forming some sort of ending pattern. Or if there is a bullish argument which one wants to make, then they may say that this is 1, 2, this is again 1, 2. But honestly, at this point of time, I am not sure if we are in an environment where we have this 1, 2, 1, 2, 3, 4, 3, 4, 5, which means a prolonged kind of up move. The simple reason being that, while I was I was checking the Twitter account as well, there are so many posts that are suggesting like excess bullishness that we are seeing in the US indices. One being that the household exposure to equity is at a record high. Okay, that was never seen before. And then the other thing was that the PMS managers, they are now putting in money in equity. That is also at record levels, and it has come towards that mark where it suggests that everyone's becoming very bullish. Then I think there was the inflows in the ETF that was at a record level, I think in month of December or Jan. So, these all sort of data, they don't give you comfort, especially when we have a very challenging, macro environment as well. And the other thing, which also actually I spoke about it few weeks or probably a month or two back, which is that the higher interest rate actually leads to derating of the equity, equity, because the reason being that, see, when the interest environment is low, okay, that's where people have they have no other revenue other than investing in equities, and that's why the P multiple expands. Okay.
Right.
The interest rates are high. They already have an alternate, to invest. Why would they actually, invest in equities where the P is very high? Okay. And that's where, the risk premium that you demand, that also vanishes away when the P is extremely high in an high interest rate environment. And I was reading somewhere that the risk premium in the US has actually become either zero or it has come down. I mean, it has got into marginal negative zone, which means that bonds are actually generating more money than the equity, and which is in bond, if you put the money at this point of time, okay, then in equity. Basically, this is from a relative perspective, that's all. I mean, it can very well happen that bonds also fall, equities also fall, and so on. But purely from the risk reward perspective, that is what it means. So when we combine everything, okay, it is not a very good picture that is there in US, but somehow the markets are shrugging off all the negative news and so on. In fact, we had spoken about yield curve inversion as well. That theory has also gone into dumps, especially when it has 100% track record if we go by the past. So I mean, when we align all the things, it 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 tells me that there is significant risk in the US indices, which probably for some reason market seems to be ignoring. Okay. Now, the thing that we also always speak with the sentiment data is also that, all these things are showing us the red flag, right? But the only thing that so far is not happening is getting a confirmation on the price action, which means breaking of averages or RMI turning into bearish mode and so on. So if we see the daily chart, yes, definitely the RMI has turned bearish, and now there is a chance that the 20-day average can also break. So again, if that breaks, then we are possibly heading lower towards the 40-day exponential average. And if that breaks, then that's where we have to be open for a significant correction in the days and the weeks to come. Now, a much bigger correction will actually kick in when the S&P averages breaks the 20-week or the 40-week average. Okay, that's where a case of a larger correction can kick in, which means that this entire pullback is complete and the next leg of decline can start, which will become basically A, B, and wave C, something like that. So that sort of bigger decline, the possibility of that will kick in once the averages break. Now, whether it happens or not, that we need to see, as and when those averages break. But that is the risk that we are dealing with right now. In fact, while Nasdaq, S&P, and all, they are at the highest levels. But if you see the internals, I mean, Apple, which is the largest, I think by weight. So over there, you see that it is at the 40-week average. Okay. And it is languishing over there. And there is a risk that it can come down, because when you see the monthly chart, okay, there the RMI has already started to roll over. And I think in the past month, it did not give a bearish crossover. In fact, sorry, it had given a bearish crossover. And basically, if this month also it continues to see the down move, then there is also a risk that we see on the monthly chart, right? And not to forget that 40-week average is nothing but the 200-day simple average. Okay, because 40 to 5 is nothing but 200. So this So Apple is basically at the 200-day average, and it is, trying to defend that. And usually we say that if the stock goes below the 200-day average, that is not a good sign from a medium to long term perspective. So that's how Apple is poised at this point of time. And in fact, this is a double top as well, right? So the picture is not so good in the US indices, but like I told you earlier, we are not getting the reversal. Okay, especially from the price action front, we are not getting the reversal on the downside. So that is something that we'll watch out for in the days and the weeks to come. But yes, I mean, overall, if we see, there are significant risks that are there in the US indices. And let's see how the data unfolds. We basically need to see close below the averages or so.
Okay, that's interesting. Thank you so much for that, Jay. So, how are the Nifty indices poised at this moment, Jay? And do you expect the up move to continue in the coming weeks?
So yes, Nifty index is interesting because it is almost 1 or 2 months now. It is at the same range. Okay. So there has been ups and downs, but largely it is at the same range. And over here, there is a lot of tug of war that is going on between bulls and bears. So, 23,500, 25,000, those are the targets that people are talking about on the upside. So we will talk in a while about the sentiment indicators on strike. But let me just first cover the structure of the charts. So when we look at the Nifty index, basically, this appears to be some kind of this appears to be fifth wave. Okay. So earlier we thought that this was an ending pattern and fifth was ending over here. Okay. But that did not happen. There was a pullback that we saw, then again an up move. Now this up move was basically corrective. Okay. Which means that this was not an impulse. So this became A, this became B, this became C, this became D, and the up move that we saw recently, that became wave E. So now in the entire scheme of things, this is now looking like a distribution triangle. Okay. In fact, technically there was this breakout that we saw yesterday, but today it came back below this line, which it had broken out yesterday, which means that possibly this can be a bear. I mean, this can be a bull trap as well. But for that, we need a confirmation that the Nifty index sustains below the 40-hour exponential average. Okay. Once the Nifty breaks and sustains below the 40-hour exponential average, that's where, we can say that possibly this is a bull trap and there is a risk of a correction. So obviously later on, the other confirmations that we would need is break of the averages and the hourly RMI turning bearish. Okay, once these all things happen, that's where then we will get those confirmation that probably the top is done, and you need to be careful. Okay.
Right.
So the 20-day average, which is at 21,800 and 21,618, is the 40-day exponential average. So these two averages are very important. If these break on the downside, then we are likely to see a deeper correction in the days and the weeks to come. Now, in fact, small and the mid caps have very interesting setup. That is because in this up move that we saw, okay, it did not break above the previous high. Okay. Secondly, the RMI did not come in a in positive mode only for the small cap index. In fact, in the mid cap index, we had seen this marginal bearish crossover, a bullish crossover. And with today's decline, we have again seen a bearish crossover. Okay. And basically, what we have so far not seen is this blue line, RMI line, coming back towards the zero line. So this is a pending thing that we are looking out for since quite a while now. So I would expect that maybe the top is either done over here or done over here, and we should be seeing a correction. And in the broader scheme of things, what it means is that this is basically 1, this is 2, this is 3, this is 4, and this is 5th right now. Okay. Now, one can argue that this 5 can again extend, that this becomes 1, minor 1 of 5, 2 of 5, 3 of 5, 4 of 5, and 5 of 5 can play out. Okay. These things can happen, but at least the argument is that at least that wave 2 should happen. Okay, based on that, we will figure out, what is really happening. I mean, are we only going to see this much correction where we retrace, say, 50% or 61.8 and we again start heading higher? Or the entire up move is done, okay, which means that this entire up move is done and we are going to see a correction of that bigger up move. So that is what, we are trying to figure out. And that's where, when we look at many of the sentiment indicators, it might probably indicate that this entire 5-wave rise is getting complete. So when we look at the mid cap and the small cap index, okay, you would actually see that the rise from this low to this high is actually a bigger 5-wave rise. Okay. If that is the case, then, we are possibly looking at a much, much bigger correction, or maybe a prolonged time correction. Okay. So, like I said, I mean, we don't know these things right now, but these are the risks that we need to deal with and we need to keep in mind. Okay, what if, I mean, you have to prepare yourself that what if the entire rise from the COVID low to the high is done? Okay, are you prepared for, a correction which can be, say, high double digit or maybe even 20% plus? That is something, that is the frame of mind that you need to, be mentally prepared for. Because if at all that happens, you should not be caught sleeping. So that is the entire, idea with which we are working. So at least as of now, this is not a market where, you buy something and you just hold for 6-12 months and you would make money, as it was like, say, in last 2-3 years or so. Okay, now this is the point where you have to start actively managing your money, because many of the stocks are breaking either the daily or the weekly averages as well. Okay, so that's where you need to be careful. And like I told you, so forget about the 2020 low, say this high. Okay, but imagine what if even this 5-wave rise is complete that we see 1, 2, 3, 4, 5. Okay, then you're staring at a double digit sort of correction. So like I said, obviously we'll go level by level. So if this top is in place, okay, then 61.8% will be the, as of now, the downside level that we will watch out for. If the 61.8% breaks on the downside, that's where then the risk of retesting the low will come into picture. Okay. So these are the risks that we are seeing right now. Now, in case of Nifty, again, this seems to be very resilient at this point of time. Frankly, there is now a small intermarket divergence which we have seen between the mid cap and the small cap and the Nifty index, because this time Nifty index had made a new high, but these all indices are not making a new high. Okay, which means actually small and the mid caps were holding with strength. Okay, but the pocket where there was strength, they are not making new highs. So that is something that we need to watch out for. And obviously, if we see the weekly picture of the Nifty index, you are already seeing a bearish crossover over here in the Nifty index. Now, at least what we would expect is that the 20-week average should be tested. Okay. And if that breaks, then the blue line, which is the 40-week average, which is, say, somewhere around 2,400 or so, that can even be tested. So, these are the risks that we see in the horizon right now, and one needs to be careful. And like I told you, break of the daily averages will be the first starting point to think of that. Okay, because Elliott wave is already showing that this can possibly be some sort of distribution triangle, which is happening at the top. In fact, if you see the Bank Nifty index, Bank Nifty exactly pull back towards the upper end of the channel, and this pullback was in a channel. Okay, and today it has given a negative daily close. Okay, now this could be a good enough point to say that probably the top could be done, but what we would want is basically confirmation of breaking of the averages. So in this case, ideally, we would expect that the 40-day and the 20-day needs to break on the downside, and the RMI needs to turn bearish. So that's where then we can anticipate that the next leg of decline can start. But remember one thing, this time around, if this low breaks, then there could be a chance that on the weekly chart, you would see that this ending diagonal pattern is getting completed, and the blue line, which so far is defended, that will also give up. And if that happens, again, that will be a sign that a deeper correction could unfold in the days and the weeks, or probably in the months to come as well. So, these are the risks that we are dealing with right now. So, just to summarize, there are some red flags over here as well. The momentum indicator also seems to be losing steam, and it is turning bearish. But price confirmation is something that we require, and basically, as we say all the time, 20-day and the 40-day, that becomes an important support in the very near term. And if these averages breaks on any of the key indices, okay, then it's we are calling for trouble. In fact, when we look at the Nifty 500 index, okay, that is basically forming an ending diagonal pattern. Okay, that is a proper ending diagonal pattern, or we in technicals we say as a rising wedge pattern. So typically such patterns occur at the top, and usually they tend to lead to a big reversal in the days to come, especially when the pattern is broken on the downside. Okay, so we can keep some margin, and we can say the 40-day exponential average, that can be the reversal point, which is 19614. If that happens, again, this would be an indication that probably this major rise that we have seen in 1, 2, 3, 4, and 5, that could be getting complete, and we are headed for a correction. So yes, broadly, that's how, the key indices are poised, and, it is calling for trouble. It's just that we need to see more confirmation, in terms of price action.
Okay, well, what are the data points on strike telling you right now, Jane?
Yeah, so one is that basically when you see the sentiment indicators, so it was just a couple of days back where during the day, okay, it was during the day when the this daily swing had actually come towards the 80 mark, but then we saw some cool off from the top, and that's where it settled at, say, 2072 or 74 or something like that. But see, it was over year only. Okay, it was, despite yesterday Nifty rising higher, the momentum swing started declining, which means that internally the breadth is declining. Okay, it is not so good, is what RMI, the daily swing was already hinting towards. And today we have seen a correction, and with that, there is a sharp dip that we have seen. So again, like I told you, this works very well from a very short-term perspective. So again, if it reaches, say, at 10 or so, or in single digits, so we will see if there is a scope of a short-term pullback or no. But as of now, even this is indicating that probably the Nifty index could head lower. And in this case, maybe the momentum swing can also head lower, because this is like a negative divergence that we are seeing. Index is making a higher high, but this indicator is not making a higher high. In fact, the other part was that when we look at the FII's positioning as well, it has been more or less flat only, right? We have seen this up move, but it is more or less flat only. And, such instances have been seen in the past as well, where you can see over here that, over here as well, that there was this sideways sort of zigzagging that we saw in their positioning, but eventually the Nifty index made a lower low. Okay, you saw something over here as well, but again eventually it fell, right? Over here as well there was some pullback that we saw, but again it declined. The only difference in this case is that this time around we are seeing a massive divergence, okay, wherein the Nifty index had made a newer high, but this time around they are not long, in fact they are short. Okay, so I would expect that their positioning, they might eventually come lower to say 1,25,000 or 1,70,000 contracts or so, and that's where, you know, then we'll start wondering if there is a bottom in place or no. But until then I think that there is I mean, even the FI's positioning is not giving us that comfort. Uh, and I would expect that this to go down. In fact, when you look at the DII's positioning, I think we had discussed about this last time as well, that, you know, whenever they their shorting comes to say around 40,000 or so, you know, that's where sort of the index tops out and we see a correction, you know, like you see over here as well. Okay, there was a correction that followed. If you see over here as well, over here as well. So you know, even the DI's positioning is indicating that there can be a downside that we can see, and it is basically when they go long by say around 40,000 contract or 65,000 contract, basically their position reaches over here. That might be the point of a bottom, because you can see over here their positioning had gone north of 65,000 and the Nifty index made a bottom. In fact, over here as well, it made a bottom, right? So ideally, we would expect that the DI's positioning will go towards the 40,000 or 65,000 mark, and that's where we might form a bottom. But until then, it is too premature to call it as a bottom or a market where we are going to see a runaway rally. In fact, I don't think we had discussed this indicator in the past, but I mean, this indicator actually, if someone sees, then I mean, it might look a little scary. The reason being that, see, Nifty index, this indicator made a high in 2018. Okay. At this point of time, the mid cap index had actually had topped out. So while the Nifty index was making higher high, the mid cap index was actually making lower highs, and eventually COVID came and everything crashed, right? Now over here, basically the black swan event was COVID, right? But let me show you something interesting. So when we go towards the history of this indicator, so firstly, let us understand what this indicator is. This is future open interest, okay, of the aggregate market. So what happens is that if the market is rising higher, the future open interest will rise higher, okay? But we want to get a range, you know, like this indicator, you know, how can we catch the tops and the bottoms through the range? So what we have done is that we have divided it by BSE 100 index. Okay. So when we do that, then we get a certain high and a certain low. Okay. So when we look at this indicator and we look at how it behaved in 2008, so you can see over here that in 2008 as well, okay, this indicator had made a high of around 1700, okay, which is where it is right now at. In fact, it is at 1707. So what followed in 2008 was a straight decline, okay. But in 2018, what happened was that there was a mid cap index topping out basically over here, okay, and Nifty kept rising higher, but you could see that even when the Nifty index is rising higher, this was trending lower, okay, which means that you know, something is I mean, rising open interest should mean, I mean, rising market should mean rising open interest as well, or this ratio also rising higher. But when it was not doing that, that is a cause of concern, okay.
Right.
Now again, that we are hitting this point, then we have to be very, very careful, from a medium to long-term perspective. So again, this is more like a medium to long-term sort of indicator. And one needs to keep in mind that when we get a price reversal on a medium-term chart, that's where all these sort of indicators will, start blinking, red light. As of now, it is like a red flag. You have to be alert. But if there is a price confirmation like break of the weekly averages and so on, then you have to be very, very careful, because this can also mean that there could be a meaningful correction in the short and the medium term.
Okay, wonderful. So I'm sure this analysis is going to be very fruitful for our viewers. Thank you so much for that, Jay. I'm going to leave a link down of Strike on a description. You get a 7 days free trial right now, so sign in. It's going to benefit you a lot. You can experience it firsthand yourself. Also follow Strike on Twitter. I'm going to leave a link down there. That's where we update our daily updates that we, the data that we extract from Strike itself. It was a lovely session, Jay. I'm looking forward to next week analysis with you. Thank you so much for your time. Take care.
Thank you.